Today's March 11th and I'm going to invest £10 a day into the stock market every single day for the next 60 days. And the stakes are a little bit higher right now because we're in a period of economic uncertainty. Trump has just invoked a bunch of tariffs, and the S&P 500 has just declined over 8% in the past few weeks and is certainly heading for market correction territory. So with the future unknown, some may say it's a good time to get started, then others may argue it's not. But to see how I get on, I guess you'll have to stick around until the end of the video in order to see the results. Do bear in mind though that this video is for educational purposes only and should not be construed as financial advice. The value of your investments may go up as well as down, and when you're investing, your capital is at risk. Nothing that I share within this video is an investment recommendation, and please be sure to always do your own research before you make any kind of investment decision. Now, in order to start making my investments, there are three things that I need to do. The first one being is to pick a broker. There are lots of different brokers out there, but here are 6 pieces of criteria that I personally look out for. The first one being accessibility. Different brokers require different minimum funding amounts. Some range from as little as £1 right there up to £100 and some even £500. And obviously, as I'm only investing £10 a day, I need a broker that can facilitate that small minimum amount. The second is availability of investments. Not all providers offer the exact same range of investments to you. Some platforms provide their own funds, whilst other platforms literally provide every investment option that you can think of. Thirdly, fees and charges. It probably goes without saying, but the lower the fees, the better, because paying too much in fees could cost thousands over the course of an investment lifetime. Next up, we've got positive reviews. I would always check out websites like Trustpilot to ensure that the broker that I'm using is well regarded from the users on the platform. Then we've got probably 2 of the most important, starting off with FCA regulated. It's important to ensure that the platform that's being used to make investments is regulated by the UK's Financial Conduct Authority, because there are certain regulations and requirements that are in place in order to protect the consumer. And if you're bored on one Sunday evening, well, I'll leave a link to the client asset source book, which details out all of these requirements that FCA regulated firms have to follow. Then finally, you've got protection by the Financial Services Compensation Scheme. This is a government-led protection scheme that means any cash held in your investment account is protected up to the value of £85,000 if the broker that you're using goes out of business or goes bankrupt. There may be a couple of other things that are important to you when you're getting started out investing, but for the purpose of today, I've partnered up with Trading 212, who have kindly offered to sponsor today's video. The second thing that I'll then need to do is to select an account. On Trading 212, you do have a number of different account options available, but as I'm looking to make investments today, ideally for the long term, I'm looking at 2 specific investment accounts. You've got the 212 Invest account and the 212 Stock Sizer account. But as I personally want to use a tax efficient account, then I'm going to use the Stock Sizer. This account allows me to invest up to £20,000 per tax year and is free from both capital gains tax and dividends tax. So that's the account that I'm going to be using today, but just to clarify, the Invest account is not a tax advantaged account, which is something that you should be aware of. Now, I already use a stock sizer with Trading 212, but if you are looking to get started out investing, well, Trading 212 have kindly offered all of my subscribers 1 free fractional share valued up to £100 when you click on the link down in the description below and open an account. Or if you have opened an account with Trading 212 in the past 10 days, if you enter the promo code Mitch, all you need to do is deposit £1 into your investment account, and you'll still be able to qualify for that 1 free fractional share. Thirdly, I then need to pick my investments. Now, you must always do your own research when it comes to investing, but for the purpose of today's video, I'm going to be using something called the Trading 212 Pies feature. Now, to set this up, there are a couple of different options available. You've got the Model Pies feature, which is almost like a ready-made portfolio from some of the world's largest asset managers like BlackRock and WisdomTree. You've got Community Pies, where essentially you can copy somebody in the Trading 212 community and the pie that they've set up. But for the purpose of today's video, I'm actually going to make my own custom pie instead. I'm going to add instruments, and all I'm going to do is I'm going to go into the most popular ETFs, and I'm going to pick the most popular one on the list, which is the Vanguard S&P 500 Accumulation Fund. This fund tracks the Standard & Poor's 500 index, which essentially is the top 500 companies in the United States of America. And because it's an accumulation fund, it means that my dividends will also be automatically reinvested too, which makes this a much more passive investment. I'm going to have the full 100% allocation to this fund. I'm also going to choose the auto invest option, so this does automatically for me. I'm going to do my initial deposit of £10, as I've said, and then I'm going to change the frequency to every single day, and I'm going to do £10 a day there as well. And we'll just set this up for the next year, as you guys can see. It also gives you a value projection as well, based on past returns, forecasting what you could potentially achieve into the future, but do always bear in mind that past performance isn't always indicative of future results. I'm going to select next. I'm going to name the pie 10 a day. I'm then going to select fund the pie, and I'm also going to use my free funds from my cash balance because I don't want to pay the 0.7% fees. I'm going to click confirm and just check that over, and then that first £10 investment has already been made. So now that's set up and done, I'll check back in with you guys in a few days time in order to see how we're getting on. Okay, so today's day 4 and we are down about 0.18%, the equivalent to about 7 pennies. Not too bad considering the S&P 500 has just entered market correction territory, being down 10% from all-time highs. Now, whilst I've been buying into the market as it's moved lower, actively lowering my cost basis, actually for many investors out there, myself included right now, my broader portfolio is down several £1,000s. So I thought I'd share some perspective based on some research that I've done on previous market corrections. So research done by Covenant Wealth Advisors shows that in the last 45 years, the S&P 500 saw corrections of 10% or more on 60 occasions. And if you count them on this year, it's 61 times, which I calculate as a market correction occurring every 1.35 years on average, even though this data actually reports at 1.2 years. Regardless, there might be some slight inaccuracies here, but we can make kind of the general assumption that market corrections happen nearly as often as you have birthdays. So they're pretty common in the world of stock market investing. And actually, based on all of the market corrections that have taken place since World War II, it's taken on average about 4 months for the stock market to recover. And whilst history never repeats itself exactly, and whilst past performance isn't necessarily indicative of future results, it does give an element of perspective at a time where sometimes perspective can go out the window. What will be interesting though is how this investment portfolio performs throughout the duration that I do this for, but I guess you have to stick around to see what happens next. Today you guys join me from a place called Abu Dhabi in Wales, where we are 11 days into this portfolio now, where the portfolio is actually up 0.48%, the equivalent of 53 pence, which isn't too bad considering that the market was down 0.6% just yesterday. So I thought in this segment of the video, I'd touch upon the strategy and how it actually works. The strategy that I'm using for this portfolio was actually a strategy that was coined from Warren Buffett's mentor called Benjamin Graham in his 1949 book called The Intelligent Investor. And he coined the strategy as something called dollar cost averaging, but as I'm investing in pounds and pence, we'll call it pound cost averaging. And the idea behind this strategy, as it's written in the book, is that the practitioner invests in common stocks with the same number of dollars each month or quarter. Now, one of the reasons why investors might do this is because markets are volatile and unpredictable. So by investing regularly, investors can reduce their risk of poor market timing, because essentially the investor that's using this strategy will invest into the market, whether the market is up, down, or sideways on the given day that they plan to invest, with the overall focus being on time in the market, not timing the market. The benefits of this is that the investor will average out their purchase price over time, essentially approximating to the mean market price. Now, providing markets continue to go up, which we hope they all do, it allows investors to essentially obtain average market returns over the long term, or at least very close to them. Trading212 have written a super useful article on this very specific strategy, and I'll leave a link to that down in the description below if you're interested in reading up a little bit more on it. It will be interesting to see how this strategy works throughout the course of this video, because as of right now, I'm being able to buy into the market at lower market prices, which might be a good thing when we look back a little bit later on down the line. Okay, so I'm recording this a day late, but yesterday the market closed in a pretty bad position. The S&P 500 was down 2% on the day, and is actually now on track for the worst quarter since 2022. Very much heading now back down into market correction territory once again, and my current investment portfolio is, as a result, now down minus 1.18%. This is with additional fears of a recession risk, with JP Morgan coming out and saying that we're now at a 40% chance of recession. And that was up from the 30% which was previously forecasted, after another slew of tariffs which have come out in the press this week. The most prominent one being a 25% tariff on vehicle imports. Trump has all of these plans in place to be finalised on the 2nd of April, and I guess we'll have to wait and see whether he follows through with them, or whether he uses this as an opportunity to then open up negotiations. Because after all, if he starts high, he can always come back down a little bit. But right now, based on the latest headlines, it looks like he doesn't really give a monkey's, and my portfolio is taking a beating as a result. Well, it's been a pretty bad day at the office today, guys, because Donald Trump has just announced a long list of tariffs, and the stock market did not like it one bit. The S&P 500 is down nearly 4% as at recording on the day, which is the biggest one-day drop that we've seen for the S&P 500 for at least a couple of years. It's resulted in the portfolio taking a bit of a hit now, being down 4.58%, the equivalent to £10.99. In terms of the lessons that we can learn from this, well, I guess there's a couple that I'd like to share. Number one being investing has to be a long-term wealth creation strategy. Whilst I will admit that these tariffs could potentially have a lasting effect on financial markets, the reality is we don't really know the direction of travel yet. And as a result, it's really important that investors very much are always focused on the long term, perhaps thinking in at least 5-year, if not 10-year intervals. The second lesson being that it teaches us the value of a diversified portfolio. When you're all invested into one single country or even perhaps one single asset class, that can lead to bigger fluctuations in the value of an investment portfolio. That might be fine if an investor has accepted the risk and the volatility within the investment portfolio and it's to be expected, but for another investor, that level of risk tolerance might not quite be the same, and they may need to kind of adjust and tweak their overall investment approach to perhaps kind of include some kind of risk-off assets instead. Those risk-off or lower-risk asset classes could include things like gold or gilts, which could lower the overall volatility of an investment portfolio. Where we go from here, though, in terms of this investment portfolio, well, I guess you'll just have to stick around and find out. Okay, so I've just had a notification on my phone. I've had to switch the camera on because Trump has paused tariffs and US markets are literally surging by thousands of points, which is just simply unheard of. Like, this is probably one of the most wildest things I've ever seen since I started out investing back in 2017, with the S&P 500 up as of right now of about 10%. So just for context, they're the rates of returns that would be more congruent with annual returns, not to be returns in a single day. It's literally the equivalent to trillions and trillions of dollars being added onto the stock market just from one single tweet. From our portfolio, though, it's still in the red, but only by just a little bit now, because fundamentally the markets are still down overall, but we're now only down about 1.6%. Now, for the most part, investing should be slow, steady, and boring, and this level of market volatility is largely unprecedented. And that's just what's happened within the first 30 days of this video. So now let's see what the next 30 days has in store. Okay, so it's been a little bit of a strange couple of weeks. We've had a little bit more back and forth on tariffs. The Fed have also been a little bit back and forth as well, but the market has started to recover just a little bit, which has been reflected in my portfolio. Since my last update, the S&P 500 is up 3.8%, meaning we're now down only 6.9% year to date. And that's as a result of a nearly now 10% rally since market lows. And whilst of course I have no idea what's going to happen next, it does just go to show just how quickly that markets can turn around. And as of right now, my investment portfolio is actually now only down 1.72%. And that's obviously as a result of continuing to buy into the market, as the market has been falling in value over the past few weeks or so. And then of course, we've obviously benefited from those lower market prices. Now the market has started to recover a little bit. All of this, of course, links back to this strategy that we're using, which is pound cost averaging, which we've already spoken about. But it's a strategy that was also featured in Vanguard's newsletter this week, where they actually outlined 3 core benefits to this strategy that I wanted to share with you. The first one being that it smooths out the bumps. They say by investing regularly, investors are less affected by short-term market fluctuations, which can lead to more consistent returns. Secondly, it mentions about keeping your cool. Of course, it can be nerve-wracking when you're investing during these volatile market conditions. But from investing regularly and consistently, it ensures investors aren't worrying as much about whether they should buy or sell or react to short-term price movements. And third and finally, they say it's all about building good habits. They say regular investing is especially beneficial for long-term goals like retirement, even referencing that it's good practice to invest little and often. The strategy that I've always rolled with since I started out investing right the way back in 2017, and it's a strategy that has allowed me to actually capitalize on these volatile market conditions,
especially now the momentum has flipped around a little bit and is very much heading back to the upside. As a result, it could mean that we finish off this video with the portfolio actually being in the green, which would probably be quite the surprise given that this is probably the worst market to invest in the last couple of years. It's been a couple of weeks since the last market update, and to be honest, that's because it's largely been status quo and there's not been a huge amount that's been happening. That was until today, where Trump actually agreed the first trade deal with the UK, and I have no idea whatsoever whether it's going to be a beneficial trade deal or not. I guess we'll just have to wait and see. In light of this deal though, the US stock market has jumped 1.44% on the day, and has actually now recovered near around 50% in the past 30 days, which again just shows how quickly things can turn around. And it's probably helped on by the fact that you've got the US president coming out and saying things like this.
This country will hit a point that you better go out and buy stock now. Let me tell you, this country will be like a rocket ship that goes straight up.
Somebody needs to whack a disclaimer on that video pretty quickly and label it as not financial advice or something. I kind of joke, he's the president, he can probably do whatever he wants, but as of right now, it's resulted in my investment portfolio being up 2.56%, the equivalent to £13.81. And I didn't think I'd be saying that at the start of the video. And with only 3 days left of this video, there's certainly all still to play for, and if you are enjoying this video, then be sure to hit that subscribe button on the channel.
Okay, so we've just completed investing £10 a day every single day for 60 days, and these last 60 days have just reminded me how important it is to stay invested into the market. Because when I first started this video, well, things were looking quite bad. Tariffs shook the market heavily, and at its worst, the US stock market was down over 15% year to date and firmly in correction territory. Whereas as at recording, would you believe the US stock market as at today has actually just turned positive for the year, being up 0.35% and is actually now up over 18% from its previous low. It's resulted in me finishing this video off with £600 invested, with a total rate of return of 11.9%, the equivalent unrealised profit of £33.32. If that's not a lesson in time in the market is more important than timing the market, then I don't know what is. And that's even across this kind of micro time frame of just 2 months. And it really does show just how quickly things can change in the stock market. Let me know down in the comment section as well what other kind of videos like this you'd like me to make. But before you go, YouTube thinks that you should watch this video next, so be sure to click on that now. That being said, I'll see you over in the next one.